I'm Charlie O'Donnell, and this is Next NYC's opening bell event. And we try to do with this series is to, bring in speakers that have sort of are part of all of our collective goals, right? Which is if you're a founder taking a company this far and to a public company, and or if you're a VC having your portfolio companies have this path to success. So let's just jump right into it. How did I miss this? I
So you were alone.
yeah, yeah, exactly. So you started off as App Boy. Yep, that was the original name of the company.
Maybe that was why you missed it.
Boy, what is this? That doesn't sound like a winner. If it had been Braves, now that's
There you go.
That's a name somebody paid for. So it was originally just like a mobile platform that mostly helped developers, I think, understand and expand their user bases. You're helping companies understand their use bases better, but now more for marketers, as I understand it. And the world has changed dramatically since you first started. And so my question is, this vision is largely the same. Maybe the customer product changes, the landscape is changed. But like looking back, founders here are trying to figure out we want the kind of vision that's going to last us 10 plus years to an IPO. And if you were to go back, what was it about that vision that made it last and viable through so many changes and through so much time?
Yeah, so I think that so most of that history is right, except I think if you were looking at it from the outside, you might think that we pivoted from selling to developers to selling to marketers as an example. But the reality is actually that we were selling to people that cared about engaging the users of their mobile apps the whole time. It's just that when we first started the company, mobile apps didn't have marketing teams because if you don't have a business model, there's not much point in trying to pour fuel on a fire that's not burning, right? But then over time, actually, the emergence of the modern growth team, which was a more data-driven, experimental kind of agile marketer, resulted in the work that we were doing becoming owned by marketing teams over time. And so it was actually an evolution of the responsibility set of marketing teams and also a maturation to us selling to marketers. But interestingly, same kind of product the whole time, right? So that was an interesting evolution to go through. And I've often spoken about how it's really invigorating to know that we sell to a collection of job titles that by and large did not exist when we started the company. And, that's interesting because when you look at it on the one hand, it's like, oh, God, how do you predict that, right? Like marketing is going to become more cross-functional. It's going to become more experimental. It's going to become more data-driven. Like the marketing teams are going to work more with data science teams and with product teams over time. Like their purview would expand. But we didn't try to predict all those little nuancey things. What we were actually working on was just fundamentals of building strong businesses, right? And so if you break down what we work on to core concepts, it's like we believe that sustainable businesses are built on the back of strong relationships with customers over the long term. And if you want to build a strong relationship with a customer or anyone, strong relationships are born of mutual understanding, shared context, shared experiences, right? And so what we tried to build in the technology was a way to better understand the humans that were in your customer base and be able to use that understanding in order to deliver better shared experiences to them, better, more relevance, more personalization and communication, but basically just this very human concept of if I'm going to build a strong relationship with someone, when I meet them, I should pay attention. Right. And by paying attention, I'll learn more about them and I'll be able to use that to have a more engaging conversation with them and a stronger relationship, right? And that's exactly what our software tries to do. And when you look at then the applicability of that to business models, it's all right, kind of, there are certain business models that are more focused on just, there's a lot of, for instance, drop shipping e-com companies that all they ever want to do is sell you one product at a small margin and they're going to run an Instagram ad model to be able to do that or whatever. And they don't really, but when we actually look at, the fabric of the economy, these are built out of long-standing businesses that invest in building brand equity and build-ups. And we were really going after those foundations of how sustainable businesses are built. And as a result, when you look at Braze's business today, highly diversified, do 45% of our revenue outside of the United States. Our largest single vertical is predictably retail and e-com as a marketing tech company, but it's actually only about 22% of our revenue. The rest is highly diversified around a whole bunch of different verticals. We also sell to pre-launch startups, and we even have like a startup free trial program. But in the same year that we launched that, we also announced our first, second, and third 10 million plus annual, customers that we have with the world's largest enterprises around the world. And so I think what we've seen over the years is that we were building for this problem that kind of exists in the foundation of building a business. And now what we've been able to do then is we've been able to pair our go-to-market investments over time in a very diversified way. And that's created a lot of durability in the business. And so, starting out in the beginning and being like, okay, and I just did a podcast last night where they asked a question toward the end, which was like, what were you smart about and what did you get lucky on? Right. And I think that one of the things that we got lucky on is that we didn't have a great answer for why now when we started the company, other than I had massive conviction that mobile was going to matter, but we were too early actually for what we were building. I remember going to mobile app meetups right here in New York, 2011, 2012. And the pitch was actually the starting pitch before you even cared about what we were building was that you also had to care about turning your app into something that would generate revenue, be a business, which like when you're building a flashlight and a compass app or whatever, it's just like, and I remember even ironically, the early App Store model where you would sell apps, if anyone remembers that, hurt us because an app developer actually made all their money up front and everything after that was just residual burn for them, right? And I remember an app developer coming up to me and being like, I don't want people to keep using my app after they download it because I have to pay for their server bills. Like I've already made all the money I'm ever going to make on them. And I thought to myself, I was like, okay, that's rational, I guess, but it's also kind of shitty. Like we should figure out different ways to monetize apps, right? But that took years. And, we ran out of money basically twice. And in all of our term sheets in the first 6 years of the company, in each round we did, we only ever got one term sheet. Like there was nothing like you see in Silicon Valley with people chasing you around and like negotiating one up the other. It was like, we found one person with a checkbook to believe in us in each of those rounds. But one of the great things about being a private company is that is all you need.
Well, and we'll jump into that fundraising story in a moment. But I do think it's really interesting that there's just sort of a really basic and simple, straightforward premise in there that it's like people are always going to want to understand their customers better, and that's something that should last through cycles or whatever. If you have something like that,
and apply to businesses of all kinds.
Right. It's widely applicable. It's applicable at different sizes. And so I do think that given how fast the environment changes, it's helpful for a startup to have a basic true north like that, as opposed to depending on, well, my true north is that people are going to use this chain versus this chain or whatever, right? Which like may not be a relevant question in 10 years, but like understanding customers is sort of pretty fundamental.
Yeah. And then you do need to tie that with a opportunity to enter the market, right? And compete against like already, legacy players or have like an edge against like people that are going to have a lot more money or a lot more hype around them in the early days or whatever. And so, finding for us, it was, really going in with event-driven stream. We had like a new technical architecture. We had event-driven stream processing. Obviously, it was we go back to 2011. It was like kind of early emergence of cloud and big data. And then was like an important foot in the door that got us into a lot of the big enterprises. And so we were working on these timeless problems, but we were then leveraging changes that were happening in the technology landscape in order to give us that wedge.
Speaking of the technical infrastructure, so you actually started as the company's CTO.
That's right, yeah.
And that position for 6 years. So obviously you got up to a pretty decent scale at that point before you moved into the CEO position. Yeah. What advantage did that give you as a CEO coming from the engineering, more product side of the company?
Yeah, I mean, I still experience this today, and I imagine what it must be like to be a non-technical CEO trying to like navigate like Gen AI and answering investor questions and being on like the prep for the earnings call where you're going to get peppered with a bunch of Gen AI questions from analysts that barely understand it. Non-technical CEO barely understands it, and you're having conversation that's just buzzwords flying back and forth, and the ability to actually cut through that noise and know, like, what actually is a good investment here, what's not, what matters, what doesn't. I think that has been one of the most enduring advantages of really having a technical CEO seat, is just that ability to navigate new waves of technical transformation. Like, we were born as a result of the massive disruption that came about due to the introduction of the smartphone and the spread of it around the globe. And, without that transformation that occurred, like, we wouldn't exist as a company. And you always need to be on guard for like, what's the next thing that's going to, you benefited from being the innovator's dilemma, right? Like, when you came into existence, like, how do you keep from succumbing to that? And I think that to a large extent, having more technical expertise has really allowed for me to better evaluate like what's noise, what's just a shiny, distracting thing versus what really matters here. And also be able to kind of predict how adjacent markets are going to develop over time, like, being able to see which parts of these emerging technologies should we invest in, partner in, et cetera. And so I think it's really been like prioritization has probably been the bigger one. And then also just being able to broadly navigate public narratives around the business and around technology in just a more apt way. I wouldn't necessarily call it less prep, because I do a lot of reading, keep up on all this stuff. But yeah, I've had a few moments recently where I'm like, man, I just don't know how people without a computer science background even try to prep for these things.
And are you able to also like pull back? I know in some of the more technical CEOs that I've backed, like getting them, you're not coding anymore, right? Like, they don't let you anywhere near the code base, but
I'd like to think they'd let me.
But is it difficult to, stay out of the weeds? Because obviously you have a technical team and they're focused on it. And do you feel yourself getting pulled back into it at all?
So when I transitioned into the CEO seat, I made the explicit choice to keep both my head of product and so I was CTO, but I had another technical CIO at the beginning, and he became the CTO. And I actually explicitly chose to have our chief product officer and CTO both separately report to me, and that still exists to this day. And so I'm still a little bit more involved in the leadership as a result of that. I didn't abstract away kind of everything, but and then we separately have a head of growth who kind of heads up the data science side of the house and some of the R&D that's more focused inward on the company rather than the R&D that's focused outward on the customer problems. And so to some extent, I've kept a little bit more cardinality, I would say, like in terms of the R&D leaders that report to me. But I think that that's a group of people. We've got a lot of tenure. There's a lot of shared trust there. My head of product likes to refer to it as getting to the point where you can do a no-look handoff, where like we can just have a quick conversation, get aligned, and that no-look handoff idea is that you can both be running as fast as you can, like next to each other, and I throw the ball and don't have to say anything, and he catches it and goes that direction, and I'll go this direction. And I think we've gotten to that point in terms of a working relationship over the years, and that affords me the ability to not have to feel like I need to be in the details of everything. But I did actually, many, many years ago, kind of establish the contract on the product side, which was like, I'm going to have all these demands like through my quarterly calendar and cycle or whatever, where it doesn't make sense for me to be in the critical path of anything in particular, because occasionally I disappear for 2 weeks to do earnings or like whatever it is, or before it was like fundraising or customer visits or what have you. But if you guys can push me the transparency on like what's being worked on early in the process, I can then opt in to engaging in the details at a point when it's less disruptive. There's nothing more disruptive than you launch something and the CEO is like, oh, what's going on with this? And then you got to go like rework it post-launch. And I've always been like, I will commit to you, I will never do that as long as you have actually given me the opportunity to engage earlier in the cycle. And if I choose to ignore, what you've pushed me because I'm busy, it's not on you, right? And so established a contract like that very early on, and we actually still work like that. So I know I get pushed various bits of the design process and everything else, and I'll decide when I'm going to look closely at things or not or what have you. But we tried to make sure that that engagement is always at a point where it's a lot less disruptive than like later in a product cycle.
Were there any disadvantages to starting out from that side, or areas where you felt like you had to level up as a CEO from the business side, and how did you do that?
Yeah, I mean, absolutely a bunch of areas where I had to level up. So go-to-market in the day-to-day running of go-to-market was one of the biggest ones, but also one of the biggest distinctions I think between, and I still actually coach our aspiring leaders on this today, where I get the question of like, what's the difference between like, a simple one, like what's the difference between being a senior director and an SVP at this company, right? And one of the distinctions that I always make is there's a difference between being in charge of a larger and larger pyramid of people that are all like you and becoming like a cross-functional member of like a global leadership team, right? Because and there's differences in the hardness, but there's also differences in perspective. Like a lot of leaders of like organizations, they kind of take it upon themselves to like defend their team, and like, they're trying to kind of provide support and things like that. And they fight for them or whatever. But it's like, when you actually are a member of a global leadership team, sometimes actually your job is to deliver the bad news to your team, because there's something that's better for the company as a whole that maybe your team's not going to like, but that's like, you're not defending them against them. You're actually delivering it to them, right? That's a big distinction. The other one is that, when you consider within engineering, like obviously every human is their own individual, but like, the people that have, for instance, opted into being software engineers, like have some shared traits about them. And when you are managing just a larger and larger pyramid of people that like, that kind of have those shared traits, they've opted in the same career, there's a lot of similarities. They're also similar to you understand them better. And now you go and have to simultaneously manage a sales team, which is extremely different from an engineering team, and a legal team, and a people team, right? And a marketing team. And those are groups of people that are both different from each other, and also likely different from you in a variety of ways. And what makes their job hard is fundamentally very, very different. I've run into this interesting example so as I encourage leaders to then, work cross-functionally, you run into these funny examples where, let's take like an engineering leader, and they're looking at like a sales problem. And it's like, I was looking at, this deal that we lost. And like when the salesperson was asked, how do you differentiate from X competitor? This is what they said. And I think that they should just say this. And then they write up something which sounds totally reasonable. They're like, let's make the sales team say this. And I'm like, a big group of hundreds of humans spread out around the entire world with totally different contexts and everything else is very different from a fleet of servers that you can write a patch. Right? Like you could write a patch and push it, and they all have to follow your directions. That is not how a sales team works, right? And similarly, that computer like doesn't lie to you, and it does not that sales people are lying to you, but selling is adversarial, right? Like the feedback that you get when you write a unit test for like, correctness in an application is not the same as presenting an answer to like someone that you're trying to sell to. That's performative. You get one shot on that stage, and the feedback that you get might be purposefully misleading, right? Very different from interacting with a computer. So, those are, and there's obviously a lot of examples like that, but I think that understanding what makes someone's job hard and really internalizing that before you try to then like lead in the details, I think is absolutely table stakes. And that's been one of the most important things for me as I became a cross-functional leader as CEO. It's like you can learning about the happy path and like just kind of how people go through their day to day is obviously valuable. But I think that the most important thing is like what makes those jobs hard, so that you can really empathize with like both how do they define winning and what's a big accomplishment, but also like, why is this job challenging? And, how do the people that opt into it, like, find fulfillment in their work through conquering those challenges? And I think that if you can learn those things, you then become a better cross-functional leader. And a lot of my journey kind of from CTO to CEO has been about learning that across more and more dimensions of the company.
Is that something that was it an epiphany one day? Was it something you had to work with a coach through, or maybe a board member, another CEO?
I mean, in the early days, it was literally just this. I had resources inside the company, right? There were people that were leaders of these other functions, and I would literally just sit in rooms with them on one-on-ones with whiteboards and be like, tell me about your org. Why? And I'd be like, why this and not that? Like, how do you, how did this design come from? Like, what is this going to look like at 5x scale? Like, how are you thinking about this leader? And just like being inquisitive, asking questions, being curious.
So the Ted Lasso stay curious model is basically
I mean, absolutely. Like when I think back to that first year as CEO, like I literally did just kind of go around the company, and every single one of those leaders was just me and them and a whiteboard, and they taught me. Crystallization of the most important part being like what makes it hard. That definitely came later as I got more and more data points and tried to coach other people on how to do this. But that starting thread is really just like, go be inquisitive, right? And ask questions. Like I've had a lot of leaders who are like, yeah, but you're the CEO. Like you can go and ask people like whatever you want. And they have, and it's just like, no. Like people like to talk about their jobs and like what makes it hard. It's, you just need to go and
give them that space.
Yeah, give them the space and give them the time and be interested, and that's pretty easy. So a lot of people don't do it.
So let's go back to the almost running out of money.
Yeah.
I'm sure it's something that, anybody in the room can sort of relate to. You talked about in interviews, and you alluded to before, that took some time to find paying customers and to find like real true product market fit and get the flywheel going. And, a lot of times the narrative in the startup world is, keep pushing, keep plugging away, you'll get 99 no's, but then there'll be a yes. What gave the team confidence that you would eventually figure these things out? And then also, what was the key to getting early investors that maybe weren't seeing the early traction to like that one investor who came through to pony up those first few times where it was really hard?
So one of the, and I think this is broadly advice for anyone looking for early stage funding, is that being able to, with the benefit of hindsight, what resulted in those early investors having the conviction to, lead with the term sheet and write the check was it's pattern matching to prior successes they had. And, I think within the company, we had that conviction in the mobile space and we had the conviction in that long-term vision. And there was there was going to be noise along the way, but we all were in firm agreement that huge businesses would be born and built to be mobile first, and that mobile would transform the enterprise, and that we were going to help them run better businesses as that happens, right? And so, even though there was these timing pressure and it wasn't that there were, we had to, in the early days, it was like, I don't think there were customers to even find, right? Because those stories
You're losing them.
Yeah, exactly. It's like we were waiting for this market to mature and, we were building along the way. And there was a bit of like, God, is this market going to mature fast enough before we die, right? Like that part mattered. But we knew that what we were working on was going to matter. It was just a question of kind of matching our ability to survive with that timing. But the pattern matching, I think that there's a lot of legitimate, I think, complaint that a lot of VCs have this herd-like behavior, right? But the thing is, you can actually use some of those behaviors that you see to your advantage to be more efficient as well. So one of the pieces of advice I always give to people looking for seed funding is man, there are a lot of angels and seed funding, venture firms and just kind of early stage venture firms out there. And there's no way that you're going to be able to go pitch to all of them. But the good news is you don't have to, because a lot of them are thesis driven, right? And there's no better thesis than I made money with a similar idea 10 years ago and I'm ready to do it again, right? And so, I think that one of the easiest ways to prioritize who you're going to approach is find an example of a company from a prior generation of technology that did very well and, did well for their investors. And it didn't need to be that they IPO'd and they were a blockbuster multi-billion-dollar company. Maybe it was just a nice little 3 or 4x and they got picked up for 100 million along the way, because that's at least enough that whets your appetite to be able to go make a run at that. And figure out who their seed investors were, because when you go pitch to that person, they're going to be like, oh man, I remember this problem space from 8 to 10 years ago and I made money on it. Let's do it again. Right. And when I kind of spoke to our early investors, there was something. It was it was the team, it was the market, it was the technical approach or whatever, but there was always that pattern matching back to a prior win that was what, I think built that conviction in the early days to support us. And then ultimately, once the numbers start to work and everything comes together, it's much easier to find investors, especially when you get into growth stage. It's a little bit more of just a spreadsheet and baking problem than it is needing to believe in something. But when you're in those early days, there's no easier belief than that this pattern matches to something I've made money on in the past. And so it's go find the investors for whom that's true. And
well, it's funny. Zach Schildkorn, who used to work at Lux and now does some fundraising consulting, just refers to that as plausibility. It is possible to make money doing this thing, as evidenced by this company that did it in a prior cycle, and there's nothing different, or there's something different that makes the opportunity even bigger now, or all of this.
And for someone to kind of believe in you, write that check, they need to believe whatever dozen, 10 things. And if 6 of them are already checked off the list because, it already happened to them once before, then you only need to prove 4 things. Whereas if you go to someone where you're kind of asking them to invest outside of their own thesis or their own history or their own experience, you got to check all 10 boxes for them, right? And that's just a lot more work.
So let's talk about hiring. How many people at the company now?
1,700.
Okay. So I'm curious about some of the most impactful bench hires along the way where, at certain points, there was a particular position that you got right, or even an area that really altered the trajectory of the company or really helped you as CEO. What were some of the sort of key positions and what did you get right about them?
Yeah, so I think there's two dimensions to think about this. One of them was really having the broad leadership bench for various like really important transition points. And so, there was the early days, which was just like build the product, get product market fit. In those days, like R&D is the most important choice that you're making. Then along the way, like, we were, winning startups here, et cetera. Then there was the point we were like, all right, now additionally, we're going to sell to the enterprise. And that was like a new skill set, a new patience, like a new practice, et cetera. And it also meant, like security certifications and long legal and things like that. And so there was a kind of generation of leaders that we brought in as we started to sell to the enterprise. And that ends up being, that was about 5 years into the company. And that was earlier than a lot of companies in the kind of mobile space were, because there were a lot of mobile startups and you could just sell to Silicon Valley for a long time. But we actually started that journey to the enterprise early. And as a result, when you kind of look at the tail of the tape, like we're the only one of our startup contemporaries that IPO'd, right? And then that kind of made it out. And a big part of it was that we got out of the kind of cacophony of competition in that startup space. And we started also we still do both, but also selling to the enterprise. But it was a new skill set, that we needed to kind of import into the business through new leaders. And then
maybe even overhire at that point for where you were at a stage, like finding somebody who had been there, done it, and maybe more.
Absolutely. Absolutely. It's a bit of it's a tough challenge because there's kind of this dichotomy of like, on the one hand, it's this great opportunity to bring in a bunch of experience at higher scale than you've had before. On the other hand, it's a great opportunity to like fuck up and accidentally bring in a career bureaucrat to a startup, right? Which is like absolutely not what you want. And like, we did screw it up, here and there as you do that. It's hard to vet for that. But if there's kind of one thing that would crystallize in your mind, is just realize that like those two people look pretty similar in an interview cycle, but figuring out the difference between those two archetypes is the difference between success and failure as you go through that stage. The next one was preparing for IPO. It was actually around the G&A functions. And one of the other things as you get to IPO is that it's really, really important that you've got stability in your leadership team for, at least 2 to 3 years after, you get through that moment in time. And one of the consequences of that is that you might have some people that are growing up with you. And it's like, all right, the challenge of the company, a company that's scaling really quickly, even just maintaining your current job is very difficult because you need to scale, your own capability at the same pace. And sometimes leaders fall behind that and then they catch back up, and they fall behind and they catch back up or whatever. And you can decide like, hey, I'm going to take a risk that this person will be able to grow versus bringing in someone from the outside that's maybe at that point, or they already have the scale that's higher. And that's totally fine to do in most roles. And in fact, I think it creates a really great internal culture of promotion and advancement and things like that. But with the IPO, one of the things that you need to do is really de-risk those growth paths around these really critical functions. So if you're like, hey, you've got a head of finance that they've been growing up with the business and they've been doing pretty well, keeping pace, but they've kind of been wavering around this line, right? It's like, that's not going to work through IPO, because you need to have high confidence that as this line inflects up and you go public, that they're going to not only like accomplish that, but stay with it for 2 to 3 years with very little risk to that. And so
that's swapping that person out when company's public.
Absolutely. Right. And so that's a really hard decision point, because you've got these people that have been growing up, and then you all of a sudden need to say, is there a 0% chance that this person's not going to continue to scale with the business for at least 3 more years? And it's like, if someone's been fucking crushing it, like, in the prior years, like, probably fine. Right. But if they've been, kind of barely keeping up, like, you probably need to say goodbye and bring in someone that's at that higher scale. And so that's another really important one. And the major reason why that one is so different is because it's the first time that you need to prioritize for stability in those leadership positions over a longer time horizon. And then the other, I would say the third one is when you start to expand internationally, because just distance and cultural differences and things like that make the odds that you screw that up a lot higher. And, we kind of did 2 things there. One of them is we definitely, overhired, to use your term, in terms of seniority. You want to, you really need someone who can fill in the context for what's going to be like a kind of nervous island of people as they're growing up with the business. The other side of it that we did, I always used to joke about this, but our early international expansion was around the current and former British Empire. Like, on the one hand was true, like we expanded into London and then into Singapore. And the reason was language, culture, similar contract law, similar labor law. And it's like, man, it is already hard enough to expand internationally. You need as many simplifying assumptions as you can get. And so that's why we did that. It's just like, instead of having everything be different, it's, distance is there, but there's a bunch of other things that are similar. And obviously it actually helps a lot being in New York. It's such a cosmopolitan international city, and it's literally closer to Europe. And so that expansion into London, actually, today, London is actually still our second largest office globally. And our global leadership team has been kind of split between the two places. We're definitely an interesting example of a company where our center of gravity is not somewhere over the continental United States. It's actually somewhere over the North Atlantic. Has certainly parlayed itself into our international business as well over the years. But those early international hires are really, really difficult.
I want to talk about the market a little bit, given your expertise and the company's expertise. But one more question about sort of the startup path. At what point did the range of potential outcomes start to narrow a little bit, where you sort of, I don't know if you've ever taken a breath up until this point, but where you felt like, okay, we're going to not only be around, but this is definitely going to be a much bigger outcome. Were there any times where you felt like this has been seriously de-risked, or even moments where you thought about, hopping off at the local stop? I don't know if there were any serious potential acquisition offers along the way or anything like that.
Yeah, I mean, I don't. I guess it depends on your definition of de-risked. The expectations.
I've never felt like that.
I've never felt like that. That didn't resonate at all, as you said. It's like there are aspects that are de-risked, and certainly the company itself, literally does get de-risked in the sense that. And that allows you to start to hire a different archetype of person who is comfortable with risk, right? And when I spoke about the bringing in the first talent that's going to sell to the enterprise, a lot of times that archetype of person is also not interested in taking early startup risk, and so there's these interesting evolutions where, on the one hand, a lot of what defines early startup culture is that everyone is a risk-seeking individual, right? And they're willing to kind of take a lead both personally and with their finances and with the company and what have you. I mean, and over time, you start to become more stable as a business, and therefore then become attractive to people that are more risk averse. And that's interesting because, on the one hand, it opens the aperture of people that you can hire and allows you to bring in people with more experience. On the other hand, that does mean that your culture is going to change as well. And I think that that's an important thing to kind of embrace and grapple with, because if you define your culture as the emergent behaviors of a bunch of people that are risk seeking, it's absolutely going to change over time and in a way that and so I think that's one of the reasons why I think defining a culture around the expectations that we put on ourselves, the way that we think about our growth potential and such, should be enduring. And so as I kind of look at it, it's it has certainly been de-risked in a variety of ways. For instance, it's even simple things can you afford for people to go out on 6 months of parental leave without it burning up your runway and killing the company? At some point that becomes true, and then you can bring in people who are at the stage in their life where they want to start a family and things like that. But when you're 4 people, things like that are a lot harder. And so there are aspects that literally do de-risk. Now, on the other hand, if you're ambitious and you're going to grow in the upper echelon of companies in your space, that never gets any easier, because it's always competitive, and there's always a bigger target, and you got to be ready for that, because it's definitely it's a long game that you got to play, and it never really does let up. Sorry if that's bad news.
So let's talk about marketing and the customer data. And you guys have a unique perspective on the modern marketing and go-to-market function in the current landscape. A lot of the VCs built companies and had successes, and companies that were in very different marketing landscapes. And a company that wants to be hyper growth today and very different marketing landscape than, let's say, 8 to 10 years ago. What do you see, especially related to the shifting spaces of where consumers are, privacy, data, where people are spending their time? What are you seeing out in the market now, and what would you advise how marketing teams should be built differently than maybe 8 to 10 years ago?
I think that, so when we look at the fundamental differences in, or what defines our best customers, is maybe a good way of approaching this, is that it's teams that are data-driven, experimental, and run in an agile fashion, right? And I think that a lot of that is just And it's a lot of the same things we talk about with reaching product market fit, which is that like the cycle time is often what matters the most. It's like, how often are you gaining new learnings and like benefiting from those and compounding them? And when we look at modern marketing teams, the ones that are doing the best work with Braze are the ones that are, they're actually operating with an agile sprint style. Like it is, typically you see more on an engineering team. I think it's interesting to think about like a brand campaign as an example. 10 years ago, would have involved like big production budgets, big media budgets. You have to go out and you're running billboards or commercials or whatever. Like those things take a long time to plan and organize. And it takes a long time it used to take a lot longer to get data on whether things were working. You'd have to do like incrementality studies over a long time horizon, look at it through a whole year. And like your whole like marketing calendar might have like 4 tentpole events and one big brand campaign in the whole year, right? Very different from like, hey, if we're going to run a 2-week sprint cycle, we're going to do 26 iterations of new like ideas this year. And we're going to have data start flowing in as soon as we launch it. And we're going to continue to have like cohort analysis throughout the year that we're going to be able to have full visibility into. One of the other really important things that's happened that's really a big part of, our success is also that because so much of this term customer 360, it like always bothers me when it becomes shorthand for like sales and service like data, because that's kind of how it's been defined by the legacy marketing clouds. But if you think back to, as a company, if I'm selling you a TV or I'm selling you a car, or I'm like, you're like kind of across anything that you would buy, it used to actually be the case that the only time you interacted with the brand was providing that product was when you bought it and if you had trouble with it, right? But now, because our lives have been so permeated by like mobile and digital devices and digital experiences, actually you have an opportunity to continuously engage with people throughout that product journey. And so the 360 actually is the lion's share of that is happening in the product. That also means that you have a data-rich environment to understand the impact of all the things that you're doing when you're trying to communicate with the customer, marketing to them, like, engaging. And so it's not just the opportunity to engage, it's also the opportunity to understand better. And if you think about what that then implies about how you should run the teams that are operating, it's like, okay, if I have the benefit of communication whenever I want and much higher fidelity data, I can actually compound those learnings a lot faster as well. And I think that a lot of it comes down to that. Automobile is one of my favorite examples of this. And there's probably, or in New York, not a lot of people that drove here today. But, for people that live in the suburbs, like you drive a car every single day and you basically never interact with the vehicle manufacturer. You like buy it from a dealership, you fill it up from an oil company, you service it, you buy accessories like at a big box retailer or online. You get insurance from a bank or a financial services company, and you'll basically only interact with the manufacturer when you're like ignoring it's that they're sending you in the mail, right? Enter the simple innovation of letting you unlock your car, a mobile app, right? Or start your car with an app.
Now you're on the app every day.
And now they can communicate with you every day. They like know about your driving habits and they have this opportunity to understand you and communicate with you based on that simple innovation. And that fundamentally changes both their marketing strategy and then long-term, like the product strategy, because once you have that consumer attention, you actually can then start to say like, okay, I know things about their driving style because there's this connected product, and I can like talk to them when they, use this app every day. Now I can actually be the one delivering them the insurance offers. I can get ahead of their service appointments and make sure that they're going to have a great experience and avoid the warranty like issue. I can now also I know the lease is coming up. And so instead of hoping that they see my commercial during a football game or drive by my billboard, I actually can communicate with them directly and get ahead of that. And I know that their driving style has changed over time. Maybe they've had kids, like whatever, right? It fundamentally changes the posture that you should have about how you understand and communicate with customers. And then once you've built up that asset of having these first party relationships where you can both understand people and communicate with them, now that can allow you to expand your business model as well. There's other great examples where like in QSR, which is quick service restaurants, like the early days of delivery, a lot of big chains that we know of and have like strong brands like affinity toward, they would work with the likes of, DoorDash or Grubhub or what have you in order to provide delivery options. And in the early days, it looked like a great deal because they were getting this incremental demand that they weren't otherwise getting. And then over time, you realize it's become a bit of a Faustian bargain because those are the delivery app's customers, not yours. And now they want to make money on the fact that they have the consumer attention. And so now you've got your loyal customers that are coming in through that aggregator, and you're not getting the data, you're just going to them because they are like reacquiring that customer for you. It's the exact same thing that happened to the travel and hospitality industry with the online OTAs. It's the exact same thing that happened with every Amazon merchant as they built their ads business. That kind of monetization of the consumer attention that's being aggressively pursued by anyone that lives in the aggregator, like part of like whatever market it is. And the right response to that for brands is to actually then figure out like, how do I build that direct connection to the customer again? And if you achieve that, you then get that opportunity to have these much more lucrative, like ancillary revenue opportunities that can drive more profit. And it can also flip the leverage. So like if I'm McDonald's and I now have enhanced takeout and I've got delivery in the app and it's actually collecting the order, now I can negotiate with delivery as if it is the commodity instead of me. It's like, hey, no, this is my customer. They came into my app, they made the order. And now you, delivery companies, get to compete with each other about who's going to drive that food to their house. And now I get to keep the margin, I keep the data, and I can communicate with the customer afterward. Right. You can kind of go through all the different verticals and industries and ask yourself, like, how is that evolution happening? And that's the crux of this, like data and marketing and all of that's evolving along with that. But it's all because businesses across every vertical now have this opportunity to build this asset of the first party relationship and the understanding around the nature of that relationship, and then the ability to communicate with them. And that, if you bring those things together, really valuable. It doesn't show up in your balance sheet, but it's one of the most valuable assets you would have as a brand. And then you need to ask yourself, how do you leverage that?
Apps I now have on my phone from stuff I bought in my house, and
Absolutely.
it's like, the baby monitor, this sort of stuff. It's like an individual app for each thing, but they have a lot of usage data.
Absolutely. It's even, I think Disney is such a fascinating example because they actually already had this multifaceted business model that I kind of hypothesized around the automobile industry, in the sense that you'd watch the shows, you'd sing the songs, you'd buy the merchandise, you'd show up in the theme parks, and like all those things were mutually reinforcing around like that brand affinity and the connection to the character, the stories. But they didn't actually have the data that could thread it all together. And enter Disney Plus. And like Disney Plus was an important example, very similar to McDonald's building their own delivery, Disney building their own delivery so that their content isn't just like helping Netflix build stronger customer relationships. It's actually helping Disney do it. But as a result, they also then understand the nature of their consumer. And it's interesting to even think back only 10 years ago, despite Disney, basically every human on this planet had some sort of attachment to the Disney brand, but they didn't know anything about it, right? It was Disney Channel was coming in through the cable bundle. It had, the merchandise was being bought at a big box retail. They were directly interacting with you in the parks, but that interaction ended as soon as you walked through the gates. And now enter Disney Plus, and they have this opportunity to learn about, like, are you there for ESPN? Are you there for Marvel? Are you there for Star Wars? Or are your kids watching Frozen on loop, every single day? And those are all very different personas. And it means that the experience that you're going to have in the park should be very different. And that ability to understand that and then monetize it all comes about because of that data asset that they've been built. And so, I think that it's just fascinating to me how this does actually apply in almost every vertical. And it's not just new companies with connected devices in your home. It's also our most storied enterprises needing to transform themselves.
Very proud of the fact that my daughter knows more David Bowie songs than she knows Disney songs. I take that as a win for a parent. I want to make sure I open it up to questions. If any of you have anything you want to ask, jump right in. Sure.
Hey, Bill, nice to meet you. For the context, I'm founder of a Series A business in the marketing tech space, and I'm curious to hear more about your perspective on kind of moving in and out of product market fit, and whether along the way you ever had moments where, okay, you think you have it, you start to explore the scale up, you start to see maybe some of the metrics aren't where they need to be, and need to kind of retrench, as well as whether you find it, you start to scale up and you start to see a need to adjust or pivot because it's starting to weaken and you might move out of it unless you change courses.
Yeah. So I think there's two things there, but the high level takeaway is that product market fit never stands still. That's absolutely to be expected in all businesses. And there's kind of two things that happen. It's like, one, I always try to remind our product org of this as well, is that we are purposefully diluting our product market fit because we're ambitious, right? And so like, as you expand your product as you like. So for instance, you've got this product that's selling great to Silicon Valley startups. Like as soon as you start to sell to the enterprise, guess what? Your average product market fit has gone down. As soon as you try to sell to a company in Southeast Asia, your average product market fit has gone down. As soon as you decide to expand the surface area of your product, you've now started to encroach in probably areas where other companies are already there. And your product market fit is probably worse than the people that have been focused working on that problem for the last, 5, 10, 30 years. And so there's a whole bunch of reasons why, as a scaling business, you are going to actively choose to make your product market fit worse. And what you get in return is the opportunity to scale, to a greater degree and across more dimensions. And that's a good thing. And so I think that that's an important active conversation to be having, which is like, we're going to go and expand our surface area into an area that is going to be more difficult. And that means that our journey of finding product market fit to some extent is like starting over. It's starting over with advantages and momentum and knowledge and what have you. But, as there's a lot of different dimensions that you expand on that are going to, and then the other side is that even product market fit in your core will be deteriorated by copycat competitors eventually. And it's not that your product market fit goes down, but it's that your ability to, your like pricing power and your differentiation in that area like starts to dilute. And that's like, it's another way of describing the innovator dilemma basically, but it's like, yeah, your product market fit is still great, but as soon as other people show up and copy that product market fit and offer it at a lower price because they built it, with the advantage of having seen you do it first or what have you, then your ability to quickly close deals and do so at an attractive price point starts to deteriorate, even if your quote unquote product market fit is still fantastic. And so I think that keeping in mind that both of those things are going to happen, your surface area is going to expand, and that will necessarily dilute the overall product market fit that you have. And the value of the product market fit that you have in your core will be constantly deteriorated through competition. And you need to be able to kind of navigate both of those at the same time. But the sum of those is that certainly product market fit is not something that you just you achieve it and you hang on to it. Like you need to be constantly vigilant around it. Question in the back?
Bill, to early days pricing, especially is really a new, how that translated to both.
Yeah. Well, so first I'll say that no matter how many times you evolve your pricing and packaging, you're always going to feel like you're not quite there yet. So like, if you feel like that, that's normal. You'll still feel like that in 10 years. The other thing that I would say is I think the most important thing that we did in our early pricing was just making sure that incentives were aligned. So for us, the core pricing unit in the early days was pricing based off of the number of monthly active users that a customer had. And this was actually at a time where we would often ask people how many monthly active users they had, and they didn't know. It really took like Facebook going public and Zuckerberg starting to report their MAU and their DAU, in quarterly earnings before people even knew those things were and started to engage in them. But the magical thing about that was that we were an engagement platform. And so if we weren't engaging people, we weren't doing our job, right? And similarly, eventually people knew the value of their engaged customers, and we were helping amplify that value. And so it was like all the incentives were kind of aligned together. It was like, you'll pay us when you're doing well, when you're engaging people. And if we're not doing our job, you're not paying us for those people. And that was in a market where a lot of people were charging for seats, or they were charging for the, contacts, like the size of your like marketing list or what have you. And we were like, we're an engagement platform. We're going to charge for engaged users. And so we were by kind of finding, and there was a lot of nuance within that and how expensive should it be. And there were all these other things. But I think the first step should be just find something where everyone's incentives are aligned. And if you can do that as your core pricing unit, you remove a lot of the other friction. There's still going to be competition and kind of pricing levels, and there's going to be add-ons and things like that. But I think challenge yourself to find that core pricing unit where all incentives are pointed in the same direction.
I feel like a lot of the AI stuff is going that way too, of like usage and queries and cycles versus seats.
Yeah, and it's like what part of like, because you always want to be close to the value equation, and you want to be able to have a straightforward ROI calculation. And so if your pricing unit is orthogonal to how the customer is generating value, that ROI equation is always harder. Whereas if I can go in and be like, hey, I'm going to charge you X cents per 1,000 monthly active users that you have, like you have a sense of like, okay, my average LTV is like $2. And if they're improving my retention cohorts by this amount, I can like do a pretty straightforward retention calculation and know what the ROI is. Whereas if I'm charging by seat, they're kind of like, okay, the number of marketers that I have, or like, and so it just, keep your, like, whatever the ROI equation is for the people that you're selling to, try to like make your pricing unit well aligned with that ROI calculation so that you can really make a strong case for why you're generating value and it's all pointed in the same line.
Take one more audience question, then I have a question there.
Of a sales tech startup. And I found it very interesting how you're selling to a lot of different firms in different industries. We find ourselves selling to...
Yeah, so two things on this. One is that we did a little bit of a NAS equilibrium optimization in the early days, because the early days of mobile, the only category that was making money was mobile gaming. But we felt that they were doing so in a way that was like not as sustainable, and also that everyone was pointed at that. And so we had this conviction that the rest of the market was going to really matter. And we kind of kept working on that and ignored the noise in gaming. And then when the rest of the market did actually come into its own, everybody else had distracted themselves and kind of built themselves into gaming, whereas we had kept ourselves more kind of generally applicable, if you will. And that actually gave us a great head start. And so one of the things a piece of advice that I often provide when people are kind of in the early days, it's like, if you are successful, you will have 100 or 1,000 times as many customers at IPO as you do today, like when you are at early stage. So therefore, like, that early niche matters, but it's really important to not get stuck in it, because it might cause you to overfit your product or your business to something that is only 1% of like what you're going to be in 5 years. And so, the early niche is certainly valuable, but in order to kind of get those early reps, get the early customer feedback, but really provide the piece of advice to like make sure that you don't get stuck on. And then the other side of that equation, though, is that I think that qualification is extremely important in the early days. I always look at this when we expanded a new market, where you kind of sit down with the sales team and it's like, okay, for you guys to hit your numbers, you only need to sell like 15 deals next year. So like you have all of Southeast Asia, right? To use this example, and you have to find 15 companies. So don't be like running around with like, poor product market fit in 6 different countries and all these, like, be really, really ruthless about how you qualify when you go after. Go find the companies that are the Malaysian equivalent of the stronghold that we already have in the US and Europe. We know all of those customer examples. We know how their business models works. We have all the proof points. And then within that, go find the ones that have like a CMO that is data driven and experimental. They've been hired in the last couple of years. They want to make a name for themselves, and they've got someone that reports to them who's has growth marketing in their title, right? And I think that one of the issues that early stage startups have in prioritizing is you have a lot of inbound and you're kind of out there, you're at meeting, you have all these warm leads or whatever, but you're not ruthless enough about qualification and really looking at what's it going to take for me to hit my plan next year? How many customers is that actually? And if the universe of customers is 1,000 times larger than that, then be really fucking picky about where you spend your time and find the companies that are well aligned with where you're going to be successful. And so there's, that scale advantage, it cuts both ways, but if you're really strategic about it, you can definitely prioritize your time in a good way.
Next question. I'd love to hear your comment on starting and growing and running a company in New York City, challenges and opportunities.
Yeah, so I think the opportunity is that New York is awesome, and I love living here, and the diversity and the cosmopolitan and international nature of the city, I wouldn't give up for anything. And so from my perspective, it was kind of non-negotiable that we were going to build it here. I think it's a little easier than it was 10 years ago. There's some great examples of businesses that really built to scale. One of the big challenges that we had in the early days is that if you wanted to have go-to-market executives or even software people that were at the scale that you were trying to grow to, there weren't prior batches of go-to-market executives that had done this before that lived in New York, or if you wanted engineers that have worked on distributed systems that, measure scale in the billions or the trillions, those distributed systems by and large were all out west, right? Or you were trying to poach from the hedge fund industry, which is very expensive, obviously. So there are some talent things you need to work through. Now on the flip side, bringing in early designers, early marketing people, et cetera. Laurel's going to laugh at this, but there's a lot of refugees from the media world that would love to work at startups that you can hire across all these other functions who definitely don't exist out in the Bay Area. And so, there's certain roles that are way easier to hire here, and then there's other roles that are a lot harder. I think it's a lot easier now with a lot of the remote we do to be able to overcome that. But also there's been, companies that have now grown up in New York, and there is a bench of more experienced people that are, that have been there, done that. I think that talent side of the equation is tougher. As I mentioned before, being in New York actually makes European expansion a lot easier. And even just that difference of 5 or 6 time zones to Europe versus 8 or 9, which is then more than a full normal workday for the West Coast, you actually can get a lot of great European talent that wants to work for an American startup, but has some battle scars from working for an American startup that is based in San Francisco. And it's both closer and closer time zones. So that's a big advantage to that I think should be leveraged by any sort of New York startup.
You guys in the office?
Yeah. I go in every day. We don't have a company-wide mandate, but we've got a good office vibe for sure. And we definitely we don't do all of our hiring in places where we have offices, but we do bias our hiring toward places where we already have offices, because even if people aren't coming in every day, like just having density and community, I think is really important. And it's even like little things like organizing volunteer events or like holiday parties and things like that. And just the fact that you can do more gatherings because you're not putting people and putting them up in hotels and such, is like, even if they're not coming to the office every day, the fact that you can bring them together for community enhancing activities of all different kinds without it having many carbon emissions and as much expense and as much time investment and such is really valuable.
Bill, thank you so much for making the time. I really, really appreciate it.
Yeah, absolutely. Thanks for having me.